So one of the issues in development is that it's easy for large organizations to lend money. They lend money to local banks, they lend money for big projects. And the reason for that is, in many countries, they're not sure that if they made an equity investment, that is to say, if they took a partnership interest in a business, whether they would be able to get paid back. So what has happened, and we've seen this happen in the 1980s when we first started, and what we're seeing right now, is that there is a huge amount of debt that people are able to make available, and they're expecting that to be repaid. Normally it's in dollars. Now lots of things can happen. The dollar can revalue. It's much higher than a Kenyan shilling or an Indian rupee. And it makes it difficult for the enterprises or for the countries to pay that back. That's how we started, frankly, when the countries had borrowed too much from banks and were unable to pay the banks back. What is needed in most countries on that is a balance between debt and equity. The United States, which has a very large and well-functioning capital market, is able to raise equity because there are means for exiting that. There's a stock market, there's other investors who are ready to buy it. That's less the case in Bangladesh, Uzbekistan, Vietnam, Afghanistan, etc., many of the countries that we have been active in. But the need for equity as a means of growing is giving the entrepreneur a buffer against unexpected changes, whether those changes are weather-related, whether those changes are because of the currency has changed, whether because there's political uncertainty. All those factors can throw out of whack something which otherwise might make sense. I'm afraid to say we're a little bit back in the future. When we started in 1989, there was excess amount of debt in the developing world. Today, there's an excess amount of debt in the developing world. In fact, almost 2 times the amount of debt in dollars as was outstanding in 2008 during the last financial crisis.